Everyone is buying Nvidia. Everyone is buying Microsoft, Amazon, Google, the obvious names, the ones that show up in every article, every portfolio breakdown, every conversation about AI, at every dinner table in every city where people pay attention to markets. And those people are probably going to do fine. But here's the thing, nobody's saying clearly enough. The companies printing the biggest returns in the next wave of AI might not be the ones building the models. They might be the ones making sure the models don't overheat, the ones keeping the lights on, the ones solving problems so unglamorous that most investors don't even know the problems exist. This is the story of 5 companies that live in that invisible layer, and the math behind why that layer might matter more than most people currently think. Let's start with something concrete. Right now, AI data centers are being built at a pace the world has never seen before. Not upgraded, not expanded, built from scratch, at scale, as fast as steel and concrete and power grids will allow. Microsoft alone has committed over $80 billion to data center construction in a single fiscal year. Meta, Amazon, and Google are spending at comparable levels. The numbers are almost difficult to process. But here's what those numbers don't tell you. Every one of those data centers runs into the same set of problems. Problems that have nothing to do with software or algorithms or which company has the best large language model. They run into physics problems, heat problems, power problems, connectivity problems, and in some cases, problems as basic and unglamorous as water. AI chips generate extraordinary amounts of heat. The servers that run them need to communicate with each other at speeds that traditional copper wiring struggles to handle. The facilities that house them consume electricity at a rate that strains regional power grids. And all of this is happening simultaneously at global scale right now. That's the gap. And sitting inside that gap are companies most retail investors have never heard of. The first one operates in a space called photonics. When AI servers need to talk to each other now, and they need to do this constantly at enormous volumes with minimal delay, the traditional method is copper wire. Copper is fine for most things, but at the speeds and distances involved in modern data center architecture, copper starts to become a bottleneck. The signal degrades, the latency adds up, and at scale, those fractions of a millisecond matter. The alternative is light, fiber optic connections that carry data as photons rather than electrons. Faster, more efficient, less heat generated in transit. A company called Illuma is building semiconductor technology specifically designed to make this kind of optical connectivity work inside the complex environment of a data center, not competing with the GPU makers, not trying to build a better chip for training AI models. Instead, focused entirely on helping servers talk to each other faster and more efficiently. The technology reportedly works, the manufacturing capabilities being built out. The supply chains are being secured. What the company doesn't have yet is a large, confirmed customer. A major OEM contract. That's the catalyst the market is waiting for. If it comes, the revenue could ramp quickly, and the stock could move dramatically. If a competing technology wins instead, the thesis weakens significantly. This is what early-stage investing actually looks like. Not a sure thing. A calculated bet on a specific outcome that hasn't happened yet, but has a credible path to happening. The second problem is less glamorous than photonics. It's harder to make sound exciting, but it might be more immediate. Data centers need water. AI chips generate so much heat that traditional air cooling systems are being pushed beyond their design limits. The industry is moving toward liquid cooling, immersion cooling, and increasingly sophisticated humidity management systems. And in regions where water is scarce or expensive, that creates a genuine operational challenge. A company called AirJoule Technologies has developed a system that extracts moisture from the air using a sorbent-based process, produces usable water, and reduces heat in the process. It's not a sexy pitch. It sounds like industrial equipment, because it is industrial equipment. But industrial equipment that solves a critical bottleneck in the fastest-growing infrastructure build-out in human history has a way of becoming valuable quickly. The company is in pilot deployment phase. Commercial products are expected later this year. Analysts who follow it project rapid revenue growth if commercialization succeeds. The risk is that it's still spending heavily and not yet generating meaningful revenue. The opportunity is that if AI infrastructure continues scaling the way most people expect, the demand for what AirJoule does doesn't go away, it compounds. The third name is about energy, specifically about storing it better. The drone economy is coming, not the consumer drones you see at weddings, military drones, inspection drones, autonomous delivery systems, aerospace applications, defense contracts. These are sectors where the performance characteristics of a battery, its energy density, its weight, its size, determine what's operationally possible. A company called Amprius Technologies is building batteries with meaningfully higher energy density and lower weight than conventional alternatives. Not incrementally better, significantly better, in ways that matter to the customers who need them. The bull case here is arguably the strongest of the 5 names on this list. Revenue growth is accelerating. Production is scaling. Institutional investors are gradually accumulating shares. The technology has real applications in defense and aerospace, sectors where procurement decisions are slow and deliberate but tend to be large and durable once made. The stock is volatile. Profitability is still ahead rather than behind. But the investors who understand this space are starting to pay attention, which tends to be the first signal worth noticing before a broader market catches on. The fourth name is different from the first 3. It's not early stage, it's not approaching commercialization, it's already there. Scalar is a cloud cybersecurity platform with real revenue, real customers, and a real track record. The reason it's on this list is that it recently sold off sharply after an earnings report where the market didn't like what it saw. Spending increased. Forward earnings projections were pressured. Investors reacted as if the company's growth story was ending. There's a reasonable case that they overreacted. The underlying numbers, customer growth, revenue growth, the scale of the platform, remain strong. The spending that's pressuring near-term earnings is investment in AI capabilities that should generate more revenue in future quarters. This is a company making a calculated decision to spend aggressively now because it believes the market it's serving is getting larger, not smaller. In a world where every company is deploying AI agents, every automated workflow is a new potential attack surface. The cybersecurity market doesn't shrink when AI adoption accelerates. It expands. Scalar is positioning for that expansion. The question is whether the market will give it credit for that positioning before or after the results prove it out. The fifth and final name is the most forward-looking of all. Most of the AI conversation right now is about data centers, massive centralized infrastructure. That's where the money is flowing today. But there's a second phase coming that most investors aren't pricing in yet. AI at the edge. Physical AI, robotics, smart devices, systems that need to process information locally without a constant connection to a distant data center. Those systems need memory that is fast, persistent, and power efficient. A company called Everspin Technologies manufactures something called MRAM, magnetoresistive random access memory, which combines the speed of traditional RAM with the data retention of flash storage, meaning the device can lose power and not lose its data. The applications span robotics, defense, aerospace, wearables, IoT devices, and edge AI systems. Everspin recently reported strong earnings, and the demand picture is improving. The stock has already moved. Volatility is likely, but if the thesis about physical AI proves correct, if the next decade really does involve billions of intelligent edge devices that need exactly what Everspin makes, then what's happening right now might still be early. The companies most people are buying to play the AI boom are the ones that are already priced for the AI boom. The models have been built, the dominant players have been identified, the narratives have been told. That doesn't mean those companies stop growing, but it does mean the market has already done a significant portion of the work of recognizing their value. The companies in the invisible layer are different. They're solving problems that most people don't know exist. They're approaching inflection points that haven't been reached yet. They're priced, in some cases, as if the AI build-out they depend on might not happen, even as the evidence that it is happening keeps compounding every quarter. The picks and shovels of any gold rush tend to do well. The trick is finding them before everyone else figures out where the mine is. And the question worth sitting with tonight is whether the mine has already been found, or whether we're still in the part of the story where most people are arguing about whether there's gold there at all.